Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com tells us about what kind of damage has been done to the major markets and where the best chances of recovery are. He also comments on the U.S. and Canadian dollars. Author of the book The Money Bubble, John Rubino, tells us what he thinks will happen with the coronavirus-caused market panic and how long this kind of financial crisis might be with us. Schachter Energy Report publisher Josef Schachter gives us a rundown on what's going on with the energy markets and the collapse of oil prices, and can Canada's energy industry survive? Plus, at the end of the show, we'll have a company showcase update from American Manganese CEO Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at ChartsByRoss. Welcome back to the show, Ross. And before we get into what's been happening on the major markets, you do have a special offer to help people navigate through these turbulent markets.
Yes, we're doing a $200 for 2 months. That's the promotion right now. The idea being that we know everybody's looking for some guidelines as the markets are unfolding here. And this is, Bob does a good job in terms of getting the fundamental side of the equation out there. I work on the technicals. And, we're sort of monitoring this market as it's walking its way down to see where the key support and resistance levels are. So for traders, we're not providing minute-to-minute ideas, but clearly putting out the key levels that need to be watched. And for the longer-term investors, we've been looking at the big picture. I have these models that I work with, our capitulation and exhaustion models, and when you get into the markets such as we are now, you clearly have to be thinking of, terms of recessionary times and what kind of action you should be looking at. And I've sent out a piece to our subscribers midweek, just showing them how when you go back 100 years, you go back to 1900, and you look at all these major sell-offs that happened around recessionary times, there are some characteristics on the way down where you can see some very deep oversold levels, and probably, I would say 90% of them are giving signals that are pretty reliable for a bounce, but you don't put in your final low until you've really had a big shakeout. And the shame of it is right now that, for all that the models that we had were calling for market to roll over after the January-February run, the indications we had to the downside really were only about to the levels that we've got right now. The 1962 model was just a clear-cut one, which looked for a 38% retracement of the whole rally from 2009. We've gotten to that level now in most of the indices. Actually, in the Russell 2000, it's now, I think, at 50 or 60% retracement. But the key is we've gotten here so quickly that the pattern developments, the waves of selling, we've got, I think, quite a bit more left here on the downside. So while we might have price levels that would be reasonable for a pretty good bounce, we haven't gone through the time period that will be pretty much necessary. So probably some pretty good opportunities, both with the bear ETFs and we recommended put options back at the end of February, and at this point, I would really be leery about doing anything there, just because the premiums are expanded so dramatically that even if we're right in terms of a continuation of the downside, there's no way that people are going to make the kind of money that was available coming off the top.
So overall, how much have the equity markets lost since this started?
Well, depending upon the index that you're looking at, I mean, I think the worst of them are down maybe 40% off the highs. You're right back to where it was when Trump was elected back in 2016. So, in terms of a correction, this would be normal. The indices down 25 to 30%. That's what you'd expect in a long-term washout in the marketplace. But as I say, this one is still, I think, got more to go. On a very short-term basis, the highs that we saw on Wednesday, Thursday, and early Friday morning, those are going to be pretty significant here. We did have a triple witching on Friday, so that's the expiration of the futures contracts on the third Friday of the calendar quarter, along with the options expiration. So a lot of volatility during the day, and especially towards the end and the aftermarket session. So it'll be interesting to see next week if we can manage to just push above those interweek highs that we had. If we don't, then I think next leg down, you're probably looking at about 2,000 for the S&P, and that's another we closed the day here at 2304, so it'll be another 300 points as far as the S&P is concerned.
What's happening with gold?
Hard break, which as everybody was moving for liquidity, they went into the safe havens originally, which was the bond of the gold. Then the gold market got caught up with everything else in terms of needing to or becoming a source of needing a source of cash. What we do like is the fact that we've stopped around the November lows here in the call it 1460 to 1500 range. It's a good support area, and we at this point probably looking for a bit of a consolidation phase. The really interesting one, looking at the big picture, is on the miners, the mining stocks. If we take the ratio of the miners divided by the bullion price, so historically I use the XAU divided by gold, and I do a relative strength on that. And when you get down so that the RSI is below 25, that becomes a very significant buying opportunity when we go back over the decades. And we closed off this week just under 30. So that is, from my perspective, we are in a position you could be looking at a really good move here as everything unwinds. The precious metal stocks in the next couple of months are probably going to become one of the best opportunities off the low. I'm sure there will be lots of others, but that sector, we've got a nice long-term history on that one in terms of what to be looking for. So I've got that high on my list, and we'll be looking for both, say, correct oversold level and then some bullish divergences. And it probably takes a matter of a couple of months. And for anybody who comes on as a trial subscriber, hopefully things happen fast enough that we're identifying the bottom of that market.
What's going on with currencies, the U.S. dollar, the Canadian dollar?
Well, I mean, clearly, the U.S. dollar is one of the biggest short positions in the world because so much money has been borrowed that is priced in U.S. dollars. So, dollar had just an absolute fantastic week here. It's not at all-time highs by any means. However, we have taken out the 2017 high, and hard to say just how far this will run. If it's a decent breakout, my gosh, the index could be at levels that we haven't seen in many decades. So, and so much of that then is part of the other side of the coin in terms when you look at the Canadian dollar. Canadian dollar just getting hammered. I mean, we were already in trouble when it came to energy prices, and then the flow of energy and pipeline construction, etc., before the COVID-19 issue came into play. So, Canadian dollar, we've gone from 76 down to 68 in a span of a month and a half. Oversold, but would you take a look at the deficits that we have, the money that the government's looking to spend? It's hard to imagine, what levels we'll be looking for eventually. Back in the 1970s and 80s, I used a technique, just like a point and figure on the dollar. And one has to remember that currencies love to trend. They will, once they get out of a consolidation, the trends will go on far longer than you can ever anticipate. And the key that we found back in the days, in the 70s when the separatist movement was alive in Quebec, was that as the dollar trended down, all you had to do was watch each bounce. As long as it continued to have lower highs, there's no reason to become bullish at all. And, we were down into the low 60s back in those days before it eventually bottomed out. This time round, we've had, the better part of a 2-3 year consolidation and maybe a 5-cent range that we're breaking down from. When you've spent that length of time consolidating and not doing well with what had been good economic times, this thing has clearly got a lot of open space to the downside.
Ross, thank you so much for the update.
Always a pleasure, Jim. Who knows what next week will bring.
My guest has been Ross Clark from chartsandmarkets.com. You can also find him on Twitter at chartsbyross. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money, John.
Hey, Jim. Pretty interesting time for us to be talking, huh?
Yes, and our first question is, has the coronavirus turned into a black swan event for the markets?
Oh, it absolutely is. This is something came out of nowhere and basically shut down big chunks of the global economy. So, this pretty much guarantees a recession in the sense that growth numbers are going to be low for a while, maybe negative in a lot of places. The big question is, will the recession turn into a depression because it shuts us down for a long time? If this is a 1-month thing, we recover from it pretty soon. If this is a 2-year thing, then, it's not clear how such a highly leveraged global financial system survives in its current form. So it's a very big deal. And the stock markets of the world and the bond markets are reacting to that uncertainty. We're having insane volatility. And this week we're heading into options expiration time. And even in normal times, you get sometimes crazy trading patterns on days like that. So this Friday is going to be fascinating.
Do you see the stock markets bottoming in here?
Well, I don't think anybody can really say anything about the financial markets with certainty because we're not dealing with a financial problem for which there are financial fixes. This is a natural disaster. So in the same way that California falling into the ocean or something like that would have long-term unpredictable consequences, this creates a lot of uncertainty going forward. So it's hard to say how this plays out. I mean, even the experts don't know how long we'll have the coronavirus with us and how virulent it's going to be and what its pattern is going to be. There's a best-case scenario here in which warmer weather in late spring and early summer causes the virus to abate because it doesn't transmit very well in warmer, more humid weather. That then buys us some time to work out either a treatment or a vaccine, or preferably both, so then when the virus season comes back in the fall, when things cool off, we're ready for it. And at that point, it becomes a recurring annoyance like the flu, rather than an existential threat to the global economy, like it is right now. There's absolutely no guarantee that plays out that way. It could be that we just can't figure this thing out. It does not go away when the weather warms up, and in fact, it spreads to the developing world, and Africa and Latin America get hit with it. And that kind of takes us to the worst case scenario where the entire global financial system is basically shut down because whole industries and whole countries are under quarantine, and what do you do if your supply chain runs through a couple of countries that are locked down and you can't get crucial raw materials or crucial components for a product you're making? So it doesn't matter if your main factory is operating just fine. If you can't get those components or those raw materials, everything shuts down for you. And, company after company and industry after industry are looking at stuff like this. So, in a way, the response of governments is a more interesting part of this story because the big central banks of the world and the major country governments are just opening the floodgates. They're trying one big thing, and then the stock market says that didn't work, and then they try another big thing, and the stock market says that didn't work, and they go even bigger. And since it's all play money, right? It's just something you type into a computer at the central bank, and then you hit send, and that amount of new currency is in somebody's account out there. There's really no limit to how high they can go. And you've got, in the U.S. now, they're talking about giving us, I think, every adult $1,000 right up front, which doesn't sound like much, but when you multiply it across 200 million adults, and smaller amounts for kids, so you multiply it again across the kids too, and you're talking fairly big numbers, up in the hundreds of billions of dollars. And that's probably not going to work, so they're going to go even bigger. So we're going to see a level of monetary policy and fiscal policy experimentation that is completely unprecedented. Nobody's ever seen anything like what's coming. Because remember, in the U.S., I don't know how it is in Canada, but in the U.S., we've already used up the big weapons that we used during the Great Recession to stop the bleeding and start the economy growing again. We have already cut interest rates at the short end of the spectrum to zero. And long-term interest rates, until just the last couple of days, were at all-time lows. So we've already used up the interest rate tool that we had last time around, And we were already running trillion-dollar deficits, and now we're going to ramp up our deficit spending to at least $2 trillion for the coming year. So we've already used up all the fiscal ammo that we had last time around. So now whatever we do going forward is going to have to be bigger and possibly different from what we did last time around. And last time around was extremely experimental and completely unprecedented in a lot of ways. So this time around, we're going to probably see the Fed start buying equities, for instance. They'll just come in and buy part of every stock in the S&P 500, or they'll buy all the ETFs and push their prices up, which then forces the ETFs to buy stock in the open market, or futures that mimic stock, whatever. It sends ripples through the financial market and raises the average price of financial assets when you do something like that. Now, that's a horrible idea. It's a terrible thing for a government to do, and yet we will probably do that going forward. And that's just the beginning. We're going to bail out every industry in sight. When the cruise line operators call the federal government and say, hey, we need $500 billion, the government's going to say, well, all right, let's do that. And then the restaurant chains come in and the airlines come in, and it's just going to go on and on. And the numbers are going to get bigger and bigger because the government isn't in a place where it can haggle. And so if an industry comes in and says, we are liquidating tomorrow unless you give us X number of dollars, the government is kind of back where it was with the big banks when the mortgage market was collapsing and pulling down the derivatives market. And the big banks went to George W. Bush and said, bail us out for $7 trillion or there will be martial law in 2 days. And that wasn't true, but Bush caved and gave them this massive bailout. Well, we're in a place now where it may be true when these industries say things like this, because the system is so fragile. We borrowed so much more money since the onset of the Great Recession that we're dramatically more financially fragile than we were back in 2006 when we were extremely fragile. So it's not clear that we can sustain any big bankruptcy by any big country, company, or industry out there. We can't let anybody go bust. Which kind of takes us to the surging U.S. dollar right now. One of the big financial black swans that you and I have talked about a bunch of times is the amount of dollar-denominated emerging market debt. In other words, a lot of countries out there, like Brazil and Colombia and Turkey, et cetera, countries like that, borrowed a lot of money in U.S. dollars, thinking that the dollar would probably weaken and it would make it easier for them to pay back the money that they borrowed. Well, instead, in this crisis, the dollar has soared, which means these debts are harder to pay back at a time when these countries are having coronavirus-related trouble, either directly or indirectly via a slowdown in the global economy. So they can't pay those dollars back, which means the big Western banks that lent that money are on the hook for whatever losses happen if those countries default, which means we're back in the 1990s when Russia was going to default and Mexico was going to go bust, and the Alan Greenspan Fed stepped in and bailed out the big banks from their very bad decisions and basically set the precedent, which has stayed in place until now, of having a Fed put. In other words, you go ahead and take any risks you want to, and if they go bad, we'll back you up, with easy money and direct loans, et cetera, et cetera. But if it works out, you keep all the fee income and you get rich. So what big banker isn't going to take that deal? Well, the latest generation of big, stupid bankers now is on the hook for all this emerging market U.S. dollar denominated debt. And they're fairly confident that the U.S. government and the European government will bail them out because we can't let anybody go bankrupt now. And that's where we are. So this goes on until the value of the currencies that these central banks and central governments are using to play their monetary games stop being valuable. And right now that's not the case. The euro and the yen and the dollar are still very valuable. So these guys can pretty much do whatever they want to in the moment. But the larger the supply of these currencies that's out there, the bigger the chance that their value can start to fall just because of oversupply. And I think that's the next phase of this. First, we deal with the bailouts, and we kind of sort of get the coronavirus under control, and then we're left with an insane amount of currency sloshing around in the world, and therefore the need for some kind of monetary reset. So this script has a few more acts. There are a few more acts in this play that have to play out before we get to the end game, which is the global monetary reset. So, other than the fact that the coronavirus is a natural disaster rather than a financial crisis, this looks very familiar. A big crisis that bankrupts a big part of the economy, that forces governments to bail out everybody in sight. That was all part of the script. So the fact that the numbers are bigger and the effect on the real economy of the coronavirus is more dramatic, despite that, we're still pretty much going where we were always going. And it's just a matter of time before we have to do that mass devaluation and go back on the gold standard and all these things that gold bugs and other crazy people have been talking about for such a long time.
Canada and the U.S. have legislation already that allows for bank bail-ins. That is, they can go into your bank account to make sure they don't go bankrupt. Should we fear that?
Well, yeah. I mean, if you own a bank account, you should probably fear it. But it's hard to imagine in this world governments doing anything that causes this turmoil out there, right? If they start sucking money out of people's bank accounts, then all of a sudden, these people who are locked up at home, can't go to their job, can't go shopping or anything, seeing their stock portfolio tank, wondering about the value of their house, wondering if they'll still have a job in 3 months or 6 months, wondering if their kids are going to be thrown out of work or die from some crazy disease. If those people, if you step in and suck money out of their bank account, it's not clear how they respond, but it won't be a happy, positive, benign thing. So it's way easier for governments just to say, you know what, these are extraordinary circumstances. Citigroup is going to tank if we don't bail them out, so let's just bail them out. We're just going to give them $500 billion of loan guarantees, and we'll leave it at that. And that's the simple way to do it, and the one with the highest likelihood of term success. In other words, it gets you beyond the immediate problem more cleanly and easily than these bank bail-ins. So, the bail-ins were a risk for more normal kinds of financial times. In other words, a recession that gets kind of dicey and the stock market is down, and who knows what's going to happen if the recession lasts 2 years, something like that. Maybe you do the bank bail-in thing, but this is orders of magnitude scarier because it's got a disease that is at the epicenter of it, rather than just some bank going bust or some stock market in some other country fail, something like that. Those are things you can handle with monetary means. This one, it's not clear you can. So probably the big governments won't want to take any chances that what they're doing has unintended consequences, and they're going to go for the tried and true financially.
If President Trump reinstated the full uptick rule, would stock markets see sustained stability? The short sellers aren't the problem here. So I would say that it really doesn't matter what the regulators do from this point of view, because if you ban short selling, that's a profound admission of weakness and failure. So all the people that are long would see this and probably just sell their stock because they don't have to worry about short sellers pushing down the price of the stock at all. But they do have to worry about the reasons for the government doing such an extreme thing. So I don't think the regulatory side of things is meaningful in this kind of world. And I think as far as regulations go, we're much more likely to see deregulation of certain industries and certain kinds of financial trading just to get out of the way and let people with capital commit that capital in a positive way. And, again, I don't think that works either. I just don't think it's very relevant at this point. I think the world is much scarier than anything that can be dealt with financial regulations at this point. What kind of recovery could be ahead for the markets?
See, that's the thing. There's no way to know. We could collapse. We could go into a depression if the coronavirus lasts long enough just to, snuff out a bunch of industries. How many restaurants are going to survive the next 6 months if the world is like it is today, 6 months from now, without a direct bailout from the government? But how's the government going to go around and bail out small businesses and know what they're doing? I mean, how many accountants would it take to analyze the books of 5 million restaurants and mom and pop stores and service industries, and to find out what a reasonable bailout is for them? It's not clear how you do that because the government doesn't have that kind of personnel right now. And where are they going to get those people in time to do it before everybody's bankrupt? So looking at it that way, it's completely possible that we see this tsunami of small business failures out there that can't be restarted very easily, because once you sunk your savings into a business and the business goes bust, you are in no position to turn around and start that business up again, right? All your money's gone. Your credit is shot. You would need a direct government loan to do that again, but how is the government going to know whether you deserve the money or not? What if you were just an alcoholic who ran your business into the ground, and then the coronavirus comes along and offers you the chance of a bailout? How many people are undeserving who would get the... Yeah, so anyhow, that's one of the ways that this lasts a long time and causes a big problem, which would then feed over into the stock market. In other words, companies would be a lot less valuable because they're making a lot less money. So the stock market could be devastated from here. Or all the money that governments are pumping into the system kind of has to go somewhere, right? And it could flow back into financial assets, just as it has done ever since the 1990s when they started playing these criminally stupid games with our finances. So we could see, the stock market just rocket from here, simply because trillions of dollars are being poured into the financial markets. And, if governments are the buyers of equities and they have unlimited money, it would be pretty aggressive of you to bet against them, right? Because on the one hand, you've got potential buyers with finite amounts of money, and on the other hand, you've got you've got a potential buyer with infinite amounts of money on one hand. And do you want to bet against someone like that? It's true that they might fail. The system might break down even with the governments doing all this, but you can never know that. So it's impossible to say what the stock market is going to do over the next couple of years. And because of that, it makes it really scary. Over the last few months, you could have made money shorting stocks, and you could have made money with volatility plays, where you bought, for instance, options that some of them bet on the upside, some of them bet on the downside, and you hope for really extreme moves to make whichever one is on that side much more valuable, and then that more than offsets the loss of the other one. And you can make a lot of money in times like the last couple of weeks playing spreads like that with relatively little risk. No guarantee it stays that way going forward. Maybe it smooths out into just a steady drip, drip, drip of the stock market falling a few hundred points every day on the Dow in the U.S. or going up a few hundred points. See, there's just no way to know about any of this. It's experimental. It's unprecedented. It's, at least in many cases out there in the world, the actions that determine how the financial markets go are being made by people who are under huge amounts of stress, who really don't know what they're doing, who didn't see this coming, don't have any understanding of where it's going, and yet they're kind of forced to act by circumstances. So that makes this totally unpredictable. I will say, though, that equities are still overvalued where they are now. They were wildly overvalued at 30% higher. But if we're just talking actual legitimate valuation for those things, they should drop another 20 or 30% easily before they become fairly valued.
We'll have more with John Rubino when This Week in Money returns.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Rubino. John, following a stock market collapse, do the large cap, mid-tier, or junior see the best returns?
Well, in stressful times, the only buyers are people who have been, or most buyers, have been traumatized by what happened before. So they look for big names and safety. So the large cap, blue chip, et cetera, kinds of assets tend to go up first. And that emboldens people who have either watched them go up or who have been in it and made some money to look for other things like those that might go up. And then they look at the mid-tiers, the online retailers who are not Amazon, for instance. And they buy some of them. And that pushes their price up. And so on until you work your way down, until you're in a big bull market and you work your way down to the really risky stuff. So, more than likely, it'll play out this way again. When and if it happens, I have no thoughts about the timing of any of this. But when it does feel like it's bottomed and it starts to move up in a kind of a steady way instead of this crazy volatility that we've had here, then you're probably best off in the biggest, highest quality names at first, with the idea of slowly transitioning into more and more risky assets as animal spirits take back over. And people get more excited and get more willing to take risks. That's human nature playing out in the financial markets as it has since the beginning of markets. It's always gone that way. So it's a pretty fair bet that it'll go this way again. But again, I don't know where that turn is. I don't know where the bottom is. I have no idea whether it's soon or whether it's far in the future. So everybody out there should be extremely careful and only speculate, which is what you're doing now if you buy stocks or bonds, with money you can afford to lose. Do not bet the rent money on anything in the financial markets right now.
Have you been buying any stocks in the past week?
No. I had some shorts that I closed out. And so I have this cash sitting there, and I've been watching, as far as going long things, I am only all about the gold mining and silver mining companies. Regular stocks just leave me cold. But I think that precious metals will have to soar in the monetary reset part of this process, and that the miners, the highest quality, best run mining stocks will just take off when that time comes. So I'm looking at a lot of the ones that have just gotten crushed. You can, like Kirkland Lake, for instance. I had some of that a while ago and sold it at $30 US. And it went way above that. I was kicking myself for not holding on to it. It went up into the 40s and possibly 50s US dollars. I forget exactly where it peaked out. I stopped looking because it was so painful. But then just lately it plunged into the low 20s. And that was looking really interesting until they made an announcement yesterday. And this is a big part of the story here. Kirkland Lake came out and said they bought back 10 million shares of stock and they doubled their dividend. Now, how many companies in how many other industries are saying stuff like that right now, right? Most companies are saying, oh my God, we bought back 100 million shares of stock with borrowed money and now we're going broke. That's more of a common story out there. But gold miners spent the past decade or so accumulating, by and large, the best run gold miners, accumulating assets, in other words, gold deposits that can be mined and sold profitably for maybe $1,200 US per ounce. So they're sitting on all these reserves that were found and worked up and valued and everything and brought to production, but that are now being sold for a higher price. So their margins are wider. Their sale prices are higher compared to their costs. Meanwhile, their costs are actually falling because a big part of their cost is oil, right? They need fuel to run their earth-moving equipment. So you combine those two things. You get a higher selling price and lower costs, and your margins just blow out. And you get a situation like Kirkland where they're making a ton of free cash flow, so they're going to return some of it to their shareholders. Well, the stock is way up today, so I missed my chance to buy it at the very bottom. But similar things are going to be happening out there across the highest quality part of the gold mining industry. Not yet for silver. Silver is still way down, but that will catch back up too. We should talk about silver in relation to gold in a second here. But the gold miners who were making pretty decent money when gold was $1,200 are now going to make much more decent money when gold is, let's say, $1,400 and oil is half as expensive as it was back then. And they're going to come out with these nice announcements. You know, while Carnival Cruise Lines is begging for a government bailout and Ford is closing down its assembly lines and laying off all its workers, a lot of these gold miners, at least the ones whose operations aren't impacted too severely by the coronavirus, they're going to be reporting positive, upbeat quarterly reports that show higher earnings year over year. That's going to make them almost unique out there. And because of that, it will attract a lot of momentum money. You know, people who look for earnings momentum or for share price momentum or for dividend yields. You know, a lot of people will be interested in gold miners if it plays out that way this year. And you can expect that to give their shares a tailwind. In other words, they should have the wind at their back as far as buying pressure versus selling pressure. And the buying should predominate. And in a non-immediate collapse kind of world, assuming that it doesn't get much worse from here, or that the trend is in the right direction in some tangible way, the gold miners ought to outperform most other stocks going forward. So yeah, I like those kinds of stocks. Wouldn't be buying Target or Tesla. Maybe Netflix and Amazon because they're stay-at-home kinds of stocks. That's probably the only play that's left out there. That and maybe biotech. You know, if you're working on a vaccine for viruses now, you're probably pretty high-priced and in demand. But generally, the only kind of actual companies that sell stuff to people that are successful in this kind of world are the kinds of companies that people tend to use more if they're stuck at home, can't go anywhere. So Netflix is seeing higher traffic, and Amazon is seeing rising sales, and they will probably do okay. But that's almost it. You know, there's not a lot else out there that is helped by what's going on in the world. So you could probably make a decent portfolio of Amazon and Netflix and the other tech-ish companies that tend to do well in this kind of a crazy world, and the gold miners who also probably will tend to do well. But beyond that, there's nothing that looks like they're out of the woods right now. Everything else looks like it still has really big challenges coming down the road, which makes them extremely risky and very hard to analyze.
Your thoughts on the gold-silver ratio? Well,
silver is a lesser monetary metal and also an industrial metal. So it's not exactly like gold, but here's the dynamic that gives that ratio some validity. And this has played out over decades and decades. When people are worried and they start looking for safe haven assets, especially in the monetary realm, they tend to buy gold because gold is the thing that has been money for 3,000 years, and it has weathered every single financial crisis in that time without exception and protected the purchasing power of the people who owned it. Okay, so people go into gold. But then they look around and think, wow, gold is ridiculously expensive. It costs how much for just this 1 ounce? And then they remember that silver has also been a monetary metal for all of that time and has held its value pretty well. With some wild up and down swings. But still, you know, over the long haul, if you have silver put away somewhere, it's worth more than the dollars you used to buy it in most times. So people say, all right, well, if I have to pay this much for an ounce of gold, how much silver do I get? And they look at it and it's like, whoa, I get this whole box of silver for the cost of 1 ounce of gold. And silver does almost the same thing as gold. In fact, it's easier to spend if everything hits the fan when the time comes, because, what am I going to do? Buy a car with gold? Okay, can I buy groceries with a gold coin? Not if it costs this much. But with silver, yeah, I can use that. It's actually a better tool for getting through what's coming. And so money starts flowing into silver, makes it go up faster than gold. And the gold-silver ratio, in other words, the number of ounces of silver it takes to buy an ounce of gold, starts to go down. And so you go down from the 80s or so, where it takes 80 ounces of silver to buy an ounce of gold, to the 20s or so, at the bottom of the cycle, which is to say when fear is at its peak and everybody's buying precious metals, that's when silver really outperforms gold. Lately, the gold-to-silver ratio has gone off the historical charts. It was 105 or something like that the other day. So by every historical measure, silver is insanely cheap compared to gold. So you could probably do a trade where you short gold and buy silver, although shorting gold is just really hard to do psychologically because you know it's going up. It's just that silver will go up more. But you could do that trade, and, if it plays out in a low-risk way, you've made a lot of money. Or you can just buy some silver coins, That's what everybody's trying to do right now, and you cannot get silver eagles. The U.S. Mint, which makes silver eagles, has run through all its silver blanks and doesn't have any more coming in immediately, so they had to stop selling silver eagle coins out there. And the ones that are being sold are sold at a big premium. So those silver is way down. Let's say it's $12 U.S. an ounce right now in the futures market, which sets the spot price that everybody looks at. But if you have to pay $20 for that same silver coin if you buy it from a coin dealer, what's the real price? The one that you see in the paper or the one that you have to pay in order to get this thing? I would argue that the real price is the actual functional price, which means that silver's going up lately, dramatically. And there's no reason to think that changes because the trend is already in place of people desperately trying to buy silver coins and not being able to buy them. So now you have this massive pent-up demand out there. Of all the people who, called their coin dealer just to see and found out that they could not buy silver at almost any price, or at least any reasonable sounding price. And so they didn't get their silver, but it's on their mind now. Which means there is a lot of pent-up demand of people who are going to jump back into the market as soon as it turns out that silver eagles are available. If a big new batch of silver eagles are made, or maple leaves or whatever, and the premiums drop briefly, people have $20 an ounce in their mind now. And if it goes down to 15, they're going to go, whoa, it got cheaper, let me buy some, and they'll snarf up all the available silver again. And we'll repeat this a few times. Now, this happened in 2008, which, Jim, you might remember this, because you're a young guy, but you're not that young. So you might have been around in 2008 and tried to buy some silver and gold and found out that it was very hard to buy it. You had to wait for weeks and weeks and weeks after you gave the dealer your money in order to get silver and some kinds of gold coins. Well, this is a repeat of that. Oh, by the way, in 2008, when that happened, that was the low for the market. Gold and silver just took off after that and had a run for the ages. It was a really amazing bull run that they had. Now we're in that place again. So it's reasonable to expect, with governments just flooding the system with cash and handing it to everybody in sight, and silver and gold being very hard to buy right now, that we're setting up for another good long run. So I think, nobody knows what's going to happen, especially not me, in the next 3 months or 6 months or whatever. But I think over the next few years, it's fairly safe to say that dynamic will play out, where a lot of people are going to want to put their money into something like gold or something like silver that is demonstrably safe over long historical time frames. And that demand will push up the price of those things and push up silver faster than gold.
Is a recession likely to happen in the U.S.?
Guaranteed. That is totally baked in the cake right now. so many industries are just shut down that, yeah, the government can give them some money, but that doesn't mean that, for instance, Carnival Cruise Lines is going to be paying its people to take people out on crowded boats anytime soon. That industry is just, if not dead, it's definitely a zombie. Same thing with airlines, same thing with anything vacation related. Very possibly same thing with real estate. I mean, how many people are house hunting right now? Most people who have a place to live are hunkered down in their place. So, it's not clear how badly that hits residential real estate, but I'm pretty sure it's going to slow down sales, which in turn will probably cause people who have to sell to cut their prices and start that kind of a downward tumble in the price of a lot of houses in a lot of markets. And that's really deflationary, right? When housing goes down, that's usually either caused by a recession or the cause of a recession. So I think we have a recession coming, guaranteed, no way around it. We're probably already in it. When they go back and date the start of the recession, it'll be sometime in our past. But will it turn into a depression? That's the big question. Does the recession last a year and then resolve and we start growing again the way normal recessions happen? Or does this thing just metastasize and grind on until everybody basically just gives up on any hope of economic growth? And I think there's a chance of that happening, which is what makes the financial markets so unpredictable right now. But as far as there being a recession right now, that's guaranteed, totally baked into the cake.
Mm-hmm. Now, we're also hearing the word depression. Do you think that's in the cards for North America or other countries?
Possibly. Mm-hmm. There are a lot of reasons to think that this doesn't go away right away, because even if the warm weather makes the virus abate a bit, it won't go away completely, I don't think. So it's still going to be scary to travel. There are still going to be industries that can't justify forcing their people to go to work, because what happens if their people get sick and then sue the company for forcing them to go to work? There's a real legal liability aspect to all of this that isn't immediately going to go away. So a lot of industries are going to be, and who's buying new cars right now? People just aren't doing stuff like they used to do. Do you want to go to a car dealer and sit in a car that other people have sat in and then sit beside the salesman who has met a whole bunch of people in the last few days and then test drive a car? Do you want to do that? Hardly anybody wants to do that. That's a crazy idea if you're worried about, picking up this potentially deadly virus that's all around now, apparently. So industry after industry is going to either slow way down or flat out shut down. Restaurants are toast. If you're a New York City restaurant owner and you're paying your bills month to month with very narrow margins, which is how normal restaurants work, and you have to shut down for 2 or 3 months, are you going to be able to keep your rent up? What about the loans that you took out? What about all the food that you've got there that's going to spoil that you bought on credit? And what's going to happen to all your workers if you have to lay them off for 3 months? Are they going to starve, or are they going to go find work somewhere else? So your restaurant folds, and multiply that by 1,000, and you get kind of what's happening in Manhattan right now. So yeah, this could be horrendous, and there's just no way to know about how the experimental monetary policy versus the deflationary crash is going to play out.
There are rumblings that coronavirus numbers might have been inflated, causing a global panic. If there's any truth to that, what would that mean for the markets? Well,
I'm not a scientist in any way, shape, or form, so I'm totally unqualified to talk about the nature of a disease or the governmental response to it, or any. I just don't know what most of the big terms mean, even, let alone how it should play out. But one thing that two things that seem very possible based on history is that governments are lying to us, which they always lie in a crisis. So we should expect this to be no different, right? Either they're incompetent and they just don't know, or they make a public policy decision to minimize the anxiety out there by saying things that they think people want to hear. Okay, so we should expect government announcements and statistics to be lies. We should expect that. Now, at the same time, it's highly likely with a disease that apparently doesn't hit young people too hard to be way more prevalent than it actually is, because we don't know. If our kid gets a cold, it might have been coronavirus, but we don't know that because, a 14-year-old catching it, we wouldn't take them in and test them if they only seem to have a cold. And that's all it is for a lot of young people with strong immune systems. So it's possible that it's way more prevalent than we think it is, but that the average mortality rate is lower than we think it is. Because if we factored all those kids who got it and got over it right away into the total number of people who have it, and we know how many people have died from it, then fewer people are dying per 1,000 people who catch it, right? So there's good news, bad news in the fact that our information is really poor. But a lot of governments are being forced into acting in ways that imply that this is a very serious deal from their point of view. So they may be lying about the statistics, but their actions imply that they think it's pretty serious. What they're seeing scares them. And I wouldn't think they would want to do things like that unless they had to, because what mayor or governor wants to shut down, the entire industries in the area in which they need to get reelected, right? You wouldn't want to do that unless you thought the alternative involved lots of people dying and making it even harder for you to get reelected. So, I think this is a real thing, and I think it's a serious thing. But beyond that, I'm totally unqualified to make any qualitative statements or quantitative statements. Either way, I'm a finance guy. So it's easier to talk about the money markets in this time than the public health trajectory of this thing.
Has the coronavirus caused disruption in China's economy?
Big time. But China also offers, a few hopeful signs because they went for it. They were slow to get a handle on this, and they tried to lie about what was happening and everything, which is what authoritarian governments always do. So it should be expected. But once they figured out it was something serious, they went for it, which is also something that authoritarian governments find easier to do than democracies. They just shut down big chunks of their country. And they did it in kind of a brutal way. There are all these YouTube videos about people being welded into their houses or who, break out through the front door and try to run, and people in hazmat suits tackle them and beat them and drag them back. There's stuff like that out there that you see from China. And yeah, they did stuff like that without a doubt. But it seems to have worked. Now, right now, China's putting a lot of factories back online and sending people back to work. So it's not clear if it's just a temporary thing where once they get back to work, they'll get infected again or anything. We don't know that for sure. But so far, it seems to have made a short-term difference in the prevalence of the coronavirus in China. And that implies that in a kinder, gentler way, the same thing can be duplicated in other countries and might have a positive impact too. So that's a hopeful thing. But you got to watch China and see how they progress from here, because we don't know if they stopped it permanently or just temporarily.
Mainstream media have been accused of lying to the people for quite some time. Why should we believe their campaign of fear regarding the coronavirus?
Well, they're sort of in the same category as the government. They have an agenda, and truth comes in a distant second to the furtherance of the agenda of the people who own most media outlets. In the U.S., almost everybody you see on TV, if you just turn on TV and watch the network news or one of the big cable channels, you're seeing something that is owned and operated by a corporation as a product line that has to turn a profit. So it's no surprise that the reporting in most of the mainstream media is biased towards making money for the people who sign the paychecks of the reporters. So if it generates higher viewership and makes more advertising money for them, then it's in their interest to dramatize a crisis and make it seem like more than it is. So there's that impulse there. But at the same time, if dramatizing the crisis costs their corporate owners money in some other way by shutting down chunks of the economy, then that's not a good thing. So I think the coverage of this in the media is determined by what's best for the corporations that are paying the reporters. And it's not always clear whether sensationalism is better or downplaying the risk is better from the point of view of, General Dynamics or somebody, or General Electric, or whoever owns these guys. So I don't think it's cut and dried. I don't think there's necessarily a political agenda in the mainstream media that's pushing it one way or another. I think that it's got various reasons to be dishonest. And what we're seeing is the interplay of those reasons as it determines coverage out there.
The price of crude has been hit. Is this in line with fundamentals?
Well, if nobody's driving, yeah, it's in line with fundamentals, because what do we need gasoline for if we're just stuck home here? I just went out and bought a new car, 2 months ago. Okay, and so my wife and I were going to be able to go in different directions and do whatever we wanted to individually. And now this thing hits, and that brand new car I bought is just kind of sitting there. It doesn't need to be there, and I don't really need to be making those payments. I could have waited and bought a cheaper car now. But okay, that's enough of a personal aside. Just in general, you use a lot less oil when you're in recession. And you use way, way, way less oil when you're in a pandemic and you're all locked down. So that tends to make the price of oil go down. Now, that's a big deal for Canada. That's one of your major exports. And you have a lot of shale oil guys there who need a certain price, right? And they've financed themselves with junk bonds, which charge fairly high interest, which means they can swing into negative cash flow territory very quickly. If they're not careful. And where did oil bottom just lately? Was it $20 US? I think that's what the low was yesterday. And it's up some today, but still, it's historically very low, and it's below break even for a lot of oil producers. So that's a huge deal, because that's a big industry. There's more than $1 trillion worth of oil related and natural gas related junk bonds out there. Just junk bonds, not all the other debt and all the other equity that's out there. And for those to start going bad, that's more than there were subprime mortgages when they blew up and almost took down the global financial system back in 2008. So it's not a small thing. And it's something that were oil prices to stay at their lows, in other words, to go back down to $20, let's say, a barrel in US dollars, that might basically wipe out a big chunk of the energy sector. And that's a huge deal for Canada. It's a big deal for the U.S., but it's monumental for Canada. So you should hope that doesn't happen.
How are the commitment of trader numbers looking for gold and silver?
They stopped mattering. This world got so crazy that it really just swamped what was going on in the futures market. I suspect that over time they're gonna moderate. In other words, they reached this huge peak of structural bullishness on the part of the speculators. In other words, the speculators, who tend to trade on emotion and momentum and therefore tend to be wrong at turning points, had gone way long in both gold and silver. But it stayed that way for month after month after month. So people basically stopped paying attention to the Commitment of Traders report and the general structure of the futures market. That it might end up mattering again, but I suspect that we're at a time when the demand for physical gold and silver might become the price driver. In other words, the price maker rather than the price taker out there. And the futures market is just going to have to follow along with whatever it takes to buy gold and silver coins out there in the marketplace. And so at that point, it won't really matter so much whether the commercials are long or short or what the speculators are doing or anything. So it definitely doesn't matter now because the big forces out there are just swamping any kind of futures games. But there may come a time when it just doesn't matter ever again, and the physical precious metals markets call the tune, and futures have to dance to it.
When the markets turn, what are gold and silver likely to do?
Rocket. They got slammed, and that wasn't a fundamental statement about gold and silver. That was people who were losing their shirts in other things, having to sell everything they had left in order to get the cash together to avoid the margin calls or to just not go bankrupt or whatever. So a lot of precious metals got dumped while that was going on. And that happened, by the way, to go back to 2008, which is not a bad template for what's happening right now in some ways. Gold and silver got whacked just like all the other financial markets, when you wouldn't think that would be true. You would think that terrified money looking for a safe haven would pour into gold and silver and that they would go up while stocks went down. That's what I hoped, and that's what other precious metals people hoped, but it didn't happen. They got crushed, and the mining stocks got crushed even worse. They just went down. Gold and silver went down by 50%. The miners went down by 90%. It was just brutal, and sort of the same thing has happened again here. And probably it will resolve in the same way with eventually, with the amount of money that's being created and dumped in the market by central banks and the deficits that are being run by major governments. There's a lot of money sloshing around out there, and a good chunk of it flows into precious metals because people are terrified. So the demand for gold and silver coins that you're seeing now that has swamped the dealers out in the world will only grow over the next few years, and that's going to push prices up and make the miners of those things much more valuable and much more successful companies. So, again, the world, as the old saying goes, history rhymes. It doesn't repeat, but it rhymes. So you get things that are sort of like other things. And this is sort of like 2008, but not completely, because 2008 was strictly a financial thing. And this is a two-pronged problem where you've got a pandemic and a financial crisis. But they're attacking it with monetary means, much bigger monetary means than they did last time around. And these experiments are going to result, this is one thing you can guarantee, is that they will result in huge amounts of new currency in the global financial system. Now, that currency may not save us from a pandemic, but it's got to go somewhere. So a lot of it will flow into safe haven assets. And the longer the pandemic keeps the real economy down, probably the better it will be for gold and silver, because the more terrified people will be, and the more likely they will be to want to hold things that are historically safe. So gold and silver benefit from this thing going on longer than we thought it would, and then being resolved with this burst of inflation from all the currency that's out there.
What do you like better right now, gold, silver, or cryptocurrencies?
Well, Bitcoin hasn't done so well in the last few weeks. It really got whacked along with gold and silver. So it was probably a victim of the same dynamic that hit precious metals, where, if you need cash, you got to get it from wherever the cash is, right? You've got to sell something and get some cash in order to solve this horrendous problem that you're looking at. So Bitcoin was a victim of that too. Having said that, I don't really understand the dynamic of precious metals because, of cryptocurrencies. Because on the one hand, Bitcoin has a limited supply that's built into its algorithm. You cannot create more Bitcoin after whatever it is, 21 million of them or whatever, which you would think would be wildly positive for its price because the supply is limited and understandable. And that should make each individual piece of Bitcoin go up or become more valuable over time. But you can you can have them. In other words, you branch a new kind of Bitcoin off of the original tree, and that goes on to trade as a separate cryptocurrency. So you actually can't control the total supply of cryptos out there. So individual pieces of cryptocurrency, Bitcoin or Ethereum or whatever, might have a limited supply. But if the entire crypto universe is just expanding like crazy, that's inflation. And that makes the dynamic of this market kind of hard to figure out. Plus, I don't know why Bitcoin goes up and down the way it does. It went from pennies to $1,200 an ounce. Then it plunged to 200 and change. Then it went up to 15,000 and change. And then it plunged back down to where it is now. What is it now? 3,000? I don't know. Or 5,000 or something like that. And I don't know why it does that. So it makes it really hard to talk about Bitcoin as an investment, because it does things that don't seem to be explainable based on the limited understanding I have of that market. So that's all I have to say about Bitcoin. It's theoretically interesting, but functionally hard to understand.
Your website is dollarcollapse.com. Why is the U.S. dollar collapsing to the upside right now?
Yeah. The basic thesis of dollarcollapse.com is that fiat currencies are inherently flawed because they basically hand their government an unlimited credit card. And human nature being what it is, those governments abuse that credit card until the supply of that currency causes its value to plunge. And if you look at a long-term chart of all the big currencies as they're denominated in gold, you see a downward trend. And if you look at just the purchasing power of all the big currencies, you also see a downward trend. So these guys are losing value year after year after year because of oversupply. Now, when we say the dollar is strong, that means it's going up versus the other currencies, and in some cases, other financial assets. But that doesn't mean it is a strong currency. It just means it's falling less quickly than the things we're using to measure it. And over time, because the U.S. is now we're doing 2008 on steroids. We're bailing everybody out in sight. We're creating huge amounts of new currency. We've got interest rates at zero already. We're going to push them down into negative territory probably pretty soon. So we're doing all the things that traditionally destroy currencies. But at the same time, the other countries with other major currencies are doing that much or more. So it's going to make the value of those other currencies go down as well. And there's no way to tell, which one goes down faster. Right now, it looks like the world is terrified. Therefore, dollars look marginally safer, and dollar-denominated bonds look like a marginally better investment than, say, euro-denominated bonds or yen-denominated bonds, or certainly yuan-denominated bonds. And that sends money flowing into the U.S. But all of this stuff is kind of meaningless in the long run, because all these currencies are doomed. They're all going to fall and then fall and then fall and then be given up on by the global financial system, and there will be a reset where maybe the things with the same names exist out there, but they'll be very different currencies. They'll be much less valuable than today's currencies are, and they'll probably be linked to gold. So, we'll hear an announcement on some Sunday night where, starting Monday morning, the gold or the dollar will be just a name for 1/10,000th of an ounce of gold. And that means that the dollar's value will have plunged during the time between the announcement and the market's opening. But going forward, it will be a sound currency because it's convertible into something like gold, which holds its value over long periods of time. So it'll still be called the dollar, but it won't really be today's dollar. It won't be this fiat currency that's based on nothing and that is declining in value year after year. It'll be a different animal. But if you hold the original currency, today's dollars, you will be hurt by the fact that your savings will have been cut by 60%, let's say, in value, in real terms. So you'll have a good currency going forward, but it'll be worth way less than the money you put into it originally. So that's my take on the dollar. It's strong now, relatively speaking, but its days are still numbered.
Is the quantitative easing likely to make its way into mortgage and consumer lending?
Well, the real estate thing is really interesting here. And I think that there's a decent chance that if, say, the 10-year Treasury in the U.S. goes down to negative 2% when things get really crazy here, because it briefly dropped below 1%. Now it's back up above 1%. But in the next iteration of the crisis, it could easily fall into negative territory, especially if the U.S. government decides that it's got to buy up all the 10-year Treasuries, and it needs a lower interest rate in order to stimulate the economy, so it picks some, negative interest rate and just buys everything at that yield. If that happens, then the 10-year Treasury goes negative, and it's a reference rate for mortgages. In other words, banks key mortgage rates off of the 10-year Treasury a lot of the time. So if that happens, and the same relationship is maintained between the rate on a 10-year bond, the yield of that bond, and the rate on a mortgage, then you could see mortgages drop from here. Whether they ever become negative or not, that would be extreme. Europe has some negative rate mortgages. So it's theoretically possible. It's not unprecedented. But the crisis would have to get a lot worse from here in the U.S. and probably in Canada for us to have negative rate mortgages. But I'll tell you what, if there is one, just on principle, I will buy a house because, I've been this obsessive finance person all my life, and to see something that extreme where people are giving you money to buy a house, I would feel obligated. And probably a lot of other people will too.
Is the coronavirus scare going to turn up or end up turning more people into debt slaves?
Well, if it works like this, if governments lower interest rates, and that leads people to borrow because money is so cheap, then yeah, you got a lot more people owing a lot more money. If they come in and just give you money directly or pay off your student loans or pay off your mortgages, then it's possible that it will relieve the debt burden on a lot of people. But of course, at the cost of, the national debt being way higher, which you could make the case that we're still responsible for the government's debt, so if you take away my mortgage, but the amount of money that I'm going to have to pay off over the years, or pay over the years to pay off the government's debt goes up commensurately. Did I really gain anything? I'm still a debt slave, just to the government instead of to the bank that owns my mortgage. So, it's not clear how all of that works out, but it's possible that in the short run, governments actually relieve people's debts as a way to stimulate the economy. And it makes it seem like there are fewer debt slaves out there. But that won't be the case because the currency that they have in their pocket or their future tax bill or something like that, some mechanism is going to exist out there for the governments to take as much money away from them as they gave to them originally.
Do you have any market wisdom you can leave us with?
Be careful. This is unprecedented. And you do not want to speculate out there or think you know what's going to happen or take any extreme chances with money you can't afford to lose. This is, it's not just a time for physically hunkering it down. This is a time for doing the same thing financially. Build cash, save money, and then see how it all plays out.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
We've been speaking to John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Our conversation took place on Thursday, March 19th. Coming up, Josef Schachter, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Josef Schachter, founder of Schachter Energy Report. You can find it online at schachterenergyreport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money, Josef.
My pleasure, Jim. Good to be with you.
So, Josef, first of all, what's new at the Schachter Energy Report?
Well, we've been, I think the oil price and the movement in the oil has been, and also the general stock markets has definitely kept us all busy. Last night we held a webinar, a quarterly webinar for our subscribers, where we talked about, the COVID-19 and the impact on the economy. Also, the oil price war between Saudi Arabia and Russia. We had used a forecast that if it got nasty and if Russia and Saudi Arabia really went at it, we see US $20 a barrel. We did get down to about $20.12 a few days ago. Yesterday there was a big bounce. Today there's a bit of a pullback in the price of oil. I think we're going to meander between 20 and 25 for into, let's say, mid-April, as we find out if the glut is going to happen and where the oil is going. At the same time, economic weakness is there, and demand for energy will come down as everybody's quarantined, self-quarantined, or quarantined as required by governments, i.e. New York City, San Francisco, etc. Large activities have been canceled in almost every city in Canada, over 50 people. So we're looking at demand coming down. We're looking at prices coming down. But at $20 a barrel U.S., nobody makes any money. And so the industry is going to be cutting back spending, and we're seeing multiple, announcements every day of companies cutting back their capex, giving up their rigs, and admitting their production levels will be coming down because they're not going to be spending enough money to replace their decline rates. So the bottom line is the stock market on the energy side has been hit pretty hard. The index, which was 150 on the S&P TSX Energy Index, not 9 months ago. You look at it was trading at 150 even in early January. Taking into account where it is today, you'll be shocked to know that we're looking at an index that's 47, and it had a low of 38. So from 150 to 39, 38.81 low. That's the kind of massacre we've seen in the sector. And the whole market's been getting clipped as we've gone from just under 30,000 to 20,000, and under 20,000, the low I think was 18,917 for the Dow Jones Industrials. It's been a very, very severe market crash. We're looking at worse than 9/11. People are pulling out 1987. People are pulling out the crash of 29 and saying that it's very similar. We went through each of the major crashes in our review yesterday, and if anyone wants to find out about it, they can just go to our website and they can look at the subscription options, and then the webinar is available in the archives as well as all of our regular reports. So that's what we've been very busy with. And I'm right now working on the next report, which is the March SCR, and that is going to go out to clients next week. And I'll be reviewing 10 more companies that have reported the results for Q4 2019. And in many of the cases, companies have cut back their spending, and so the forecasts and the estimates have come down sharply because companies are planning to take into account these very, very bad prices and make sure that they survive. The basic story for the industry, both the energy and the energy service, is how can we survive if these prices continue to stay in this range, and also if the virus continues to put severe impact on the economy and it lasts for any length of time. If the virus is over, like 2 months, it started in January, we're now seeing economic recovery in China, but then you look at the problems going on in Italy and Spain, and you wonder, are they going to last 2 months, 5 months, a year? And so companies are now saying, we don't know how long this is going to last. What do we do to make sure we survive in the worst case scenario?
So what exactly happened to the crude oil market?
Well, crude oil, as you know, at the beginning of the year was, sitting in the $60 range. If you remember, it had a spike up when we had the assassination of the Iranian terror leader, the General Soleimani, and so the price high for 2020 was 65 in the first week of January, and the low, as I mentioned, was that 2010 or so that we just saw a week ago or a few days ago. So we're looking at a market that's been devastated. It's trading at less than a third of what it was trading on the first few days of January. And the industry cannot function at these kinds of prices. So all drilling is stopping. High-cost production is being shut in, be it natural gas or be it oil. And the industry is saying, what do we need to do to stay in business? The problem you have is if the oil and gas industry slows down its drilling, stops drilling, we're heading into breakup, which means there's not much activity happening during spring until the road bans come off. So the service industry is going to go through a very, very tough time here. And the oil and gas companies, especially if they have any debt load, are going to go through a very tough time as they try to resolve that they get some support and some time delays on their debts that are maturing. And that's, of course, what everybody's waiting to see from the Minister of Finance. They said they were going to do some support for the energy sector. AMY.V, the banks, and everybody have been talking about support. But there's a lot of banks that have debts that are maturing in 2020 that are having a gun to their head and that are hoping that there's some support coming that will allow them to extend those debts. Even these companies have the ability to pay the interest payments. The question, though, is the maturity, and they need delays on the maturity, and hopefully that's what does happen, in the coming weeks, because the industry is precarious enough. And of course, I don't think we want to see more bankruptcies of companies that are basically healthy, but just have a maturity schedule on their debts that need to be extended.
Is the drop in oil prices the so-called canary in the coal mine for recession?
Well, I think it's very clear we're going into recession. The number of people that are at home, the number of businesses that have closed, and especially in the service-related sectors, and people are waiting to find out about their early access to EI in Canada, all of that is going to affect it. There's different kind of comments you're hearing, everything from 3 to 4% real GDP decline in Q1, and in Q2 6 to 8%. So you're getting big numbers. And then if we recover in the third quarter, then we've had 2 bad quarters, and it was a nasty recession. If the unemployment rate then gets to 7, 8, 9% is what you'd be looking at in that kind of environment. If this thing continues into Q3 and you have 2 negative quarters and the unemployment rate gets over 10%, then you're talking the word depression. So we don't know the answer to that because we don't know the response of COVID. You can see in China that they're getting a handle on it and their economy is recovering. You've heard announcements from companies on CNBC and Bloomberg where their businesses in Hong Kong and Shanghai and in country and their supply chains are back working. But what's going on in Italy and Spain is a different story. And we just keep on hearing now the higher fatality rates. There's more fatalities in Italy now than there was in the whole of China, and I think there's a big population difference there. So there's a lot of unknowns, but the energy industry is trying to find a way to survive in these low prices. And of course, if you cut back production and you cut back high cost production, we're going to see the Canadian industry, have significant declines, which at some point when things settle down would imply that to get the industry back up on its feet and to get the worldwide industry back up on the feet, we're going to need to see significantly higher oil and natural gas prices longer term, because the companies are going to be in such bad shape that the first thing they do is they get more cash flow and higher commodity prices is repair their balance sheets and take care of any debt issues before they start spending money in the ground to grow production again. So this cathartic action that's going on right now, from the double black swan of one being the COVID and the health issues there worldwide, and then number 2, the oil price war, which was stupid, didn't make any sense and didn't need to be done. I think Saudi Arabia is facing leadership issues there, where you heard the President of the United States say that he likes the low prices for now, given the weakness in the U.S. economy. But at some point, he doesn't want to see the U.S. oil and gas industry destroyed. So once they get control of the COVID in the next month or so, hopefully, I think a phone call to the king of Saudi Arabia is probably likely where the Crown Prince and his move to have a price war is going to be the subject, where the President of the United States may say to them, "Well, we have an umbrella that protects you. Our military umbrella is not going to be there if you're going to destroy our oil and gas industry. Take it or leave it."
The U.S.
I think there'll be hardball at some point.
The U.S. government now has their strategic oil reserve buying oil now from the small oil companies, who, of course, will be the hardest hit by the downturn. Is that a good move, and could Canada do something like that?
Well, the United States has storage facilities which if you pull out the EIA data, which I'm just going to do right now, total SPR, which is right now, the SPR holds about 630 million barrels. So they're talking about adding another 70 million, and most of it is heavier crudes. But each of the different storage facilities can handle different types of grades. So the grades that they can use are the ones that will be bought. And of course, a lot of it is heavier crude, and a lot of the new production coming on in the Permian and the Eagle Ford is lighter grades. So those grades will be exported. And last week, for example, exports rose 968,000 on the report that came out Wednesday of this week to 3.41 million barrels a day. And so the U.S. is exporting light oil to the countries that want it, and they're importing heavier crude. Canada, just going through the Canadian data that came out with the report on Wednesday, we shipped to the United States 3.8 million barrels last week, which was up 179,000 from 3.624 the week before. And a large bunch of what we ship to them is heavier crudes, which is what the refineries on the Gulf Coast of the United States need, and a lot of the refineries right across the Midwest need. So we're providing oil that used to come from Mexico and heavy and from Venezuela, and so we Canadian energy companies have benefited from the loss of market share from those two countries. But the storage is really going to be the issue. It will help. It will hopefully, strengthen prices, and that's what the bounce was yesterday, as well as the president's comments that he would call the Saudi Arabia at some point and put pressure on them and Russia. But I don't think he's going to do that until the COVID issue is under more control.
We'll have more with Josef Schachter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Josef Schachter. Josef, how low is the price of Canadian crude versus world crude?
Well, the issue for us is, of course, our Canadian dollar is going down. So if we get U.S. dollar pricing and the exchange rate was 131, and now we're looking at, let's say, 143, whatever the price is, there's a bounce in Canadian dollar terms. The problem, of course, is that heavy oil has gone down to like $9 U.S., the WCS price. And so a lot of heavy oil in Canada is totally uneconomic now, and it's very likely that we're going to see a lot of that shut in. And companies are very quick. The issue they have is if they have firm transportation, then they have to wait till that transportation contract is over. But once they can get out of a lot of the overhead contracts that they have for their commitments, and the barrel of oil does not generate enough to cover the day-to-day operating costs, they will shut it in. And then, of course, they save the operating costs, they save the royalties. The problem is, of course, there's no contribution to G&A, but a lot of companies are also gutting their G&A. Sad to say, but I think in the next month or two, given the severe cutbacks we're seeing in CapEx programs for 2020, that there's another round of serious layoffs that are going to occur in the oil patch across Western Canada, and Calgary will face a big chunk of those layoffs.
Do you follow the gold-oil ratio?
I've looked at it, and the gold-oil ratio is now very high. Gold, of course, is a place where people go to hide when there's duress in the economy. But even if you look at the action when we've had these 1,000-point up and down days, and especially on the down days when there's been margin calls, we've seen gold get hit because you're seeing people having to liquidate even an asset they want to meet margin calls in assets that they can't liquidate. When you get a margin call, you sell what you can sell, not what you want to sell, because you have to pay that margin down. So a lot of people who went into gold and did very well in gold are now seeing gold retreat simply because of the fact of the liquidity that and the security that it had, and that they needed to meet other calls for cash, and they had to liquidate their successful investment in the precious metals.
When the price of oil drops significantly, how long does it usually take for the price to recover?
Well, historically, it's been like months. We've seen kind of almost like a V, and you see the price of oil recover. I'll give you a few examples on that. In a second, I'm just pulling out the chart. In 2014, we were $107 oil, and OPEC produced too much and glutted the market. And the price of oil fell into early 2015 to $42. So that was in a matter of 6 months. It bounced up to 62 when they started managing the supply and demand. And then again, they overproduced, and we went down to $26 in February of 2016. Well, by June of that year, we were over $50 again. So those kinds of quick declines can happen. In 2018, we were at 76.90, and again, there was a glut and also a weakness in the economy and a weak stock market at the end of 2018, if you remember, and the price of crude went down to $42. Within 4 months, it was 66. The big one that most people would remember was the crash the financial crisis of 08-09. The price of oil was $147 before the financial crisis hit, and in a matter of 6 months, it went down to $33, and 6 months later, it was $73. So these massive disruptions in price make it that the industry is not functioning and can't function, and so the industry just shuts in, and then as the supply comes down, the time window for the price to recover picks up, but it's a while before the industry has the cash flow to start spending and bring on more production. And so I think this kind of price movement where we went from say high 40s in the beginning of this month, which was 20 days. We're only into the month, and we've gone from $48 to $20. It's like the cathartic shakeout we saw in 08-09. It's unsustainable decline in the price of crude, but until we have some light on COVID, we're probably going to stay in a 20 to 25 range until we get some comfort that there is daylight there, i.e. the quarantines have worked, the number of caseloads have come down, there's enough masks, there's enough ventilators, the hospital system is taking care of those who are ill, and we're beginning to see recoveries. Then I think we may be looking in May, June, where prices could recover to $50 or $60 US, and the Canadian stocks have been absolutely decimated, be it Suncor, C&Q, Birchcliff, Tourmaline, you name the name. Also the service, the infrastructure stocks, Enbridge, Pembina Pipeline, all these, TransCanada or TC now, all of them have totally been shafted, and there would be a very strong recovery for people who are patient enough, and for those who have cash and take advantage of the weakness of the market, buy the names that are the quality names, and I think if you look at the portfolio 6 months from now, 2 years from now, 5 years from now, I think you're going to be very pleased by taking advantage of the shakeout that we've seen here. We've told our clients months ago to have cash. We talked about the overvaluation of the U.S. market, the FANG-related names especially, and we said hold some cash. We were waiting for some buy signal to occur. Those buy signals occurred last week on March 12th. So on March 13th, we sent out an action alert to our client base saying, the market has now kicked off these buy signals. Here's 8 more stocks that we find are attractive, plus the ones that we currently have on the list, and we were saying to be a buyer. And for example, in my case, the names that were already on our action alert list, I was a buyer of some of those names, adding to our portfolio, and so we were taking advantage of the bargains. And I intend to, over the coming weeks, take advantage of even more bargains and put more of the cash on the sidelines to work.
Husky bounced back so quickly and so high on Friday, they put a stop order on it.
Well, Husky's high today was 356. The low on Friday, 287. The last quote I have is 305, so it's up 9.3%, 26 cents. And you can see that gap there, between the numbers is almost 70 cents between the high and the low. There's concern about the company, how much more they're going to cut their budget back, even though they've made an announcement. But more importantly, people are wondering if the dividend is secure. And so there's rumors it's going to be paid, it's not going to be paid, and the stock runs around like a yo-yo. The fact that they cut back CapEx so much and that they're delaying a lot of the number of their projects means that they might be able to pay. The bottom line for all of these companies that are dividend model securities is, if you have debts, and you have debts to your bank or your lenders, if they say, we want you, if you want our continued support, you have to make a change to, number one, your normal course issuer bids, stop them, and number two, you have to cut your dividend or remove your dividend. If you're a debtor, you have no choice. You have to listen to the people lending the money to you, unless you have another way of refinancing that debt. And so that is what we're seeing right now, where a significant number of companies in the patch are cutting their dividends so that they can show their lenders that we are working in survival mode, and that we understand that we're now in uncharted territory, and that for this, until we know how this is going to go, we will do whatever we need to do to keep the company functioning, and to do what we need to slow our business down, and make it through these uncharted and uncertain times, and how long they last, which is uncertain.
President Trump has made the U.S. a crude oil and natural gas independent country. Is that a good move for the future of American energy?
Well, I think every country wants to be energy self-sufficient. If you look at the numbers for the U.S. last week, they were producing 13.1 million of domestic oil production. NGLs and others was another 7.1. So they were 20.2 million barrels of domestic production. That includes ethanols. And their product supply, how much they were consuming in the country, was 21.48 million barrels. So they still were importing some oil, but given where they imported from countries that are hopefully considered secure countries. Canada, for example, as I mentioned, sent them 3.8 million. Mexico shipped them 816. Saudi Arabia was the second, was shipping to them 425,000 barrels a day, and Iraq 169, Colombia 293, Ecuador 216. So two of the countries from the OPEC world were shipping oil to the States, Saudi Arabia and Iraq, but the majority of the production that they're bringing in is coming from Canada and from Mexico, which of course, from a political security of supply, definitely would be where the Americans should be wanting to get their imports from.
I think you touched on this earlier, but have you been buying oil and gas stocks this week?
Yeah, I was buying the companies that are the ones that I like. The natural gas names a lot. I like some of the light oil names in Canada. I like companies that are paying dividends, even if they're reduced dividends. The stocks have gone down massively relative to the dividend cuts that they've had. And I'm continuing to build a buy list here. Got cash on the sidelines, and I'm nibbling away as we see significant down days. Today we're down 200 on the Dow, but we're not 1,000 or 2,000 down on the Dow. And there, we've had days like that. And whenever there's those kinds of days, I kind of nibble and I just look at where the bids are. I have companies that I want to own for the long term, so I'm trying to build portfolios around those. And then when I look at the prices and say, okay, this one's very cheap today, and they're throwing it away, what happens is margin calls go out, or people just say, I want out, or some analyst downgrades it on the street, and yet I think that they're being overly pessimistic. that's when I come out and say, okay, it's on our action alert list. Our clients know it's cheap. I'm going to buy it. And then when we have our next report to our clients, they see something called the SER ownership page in our reports. They see what we've been buying, and we declare on every issue what we bought in the last 30 days and the price we were willing to pay, so they can see what we think is cheap and what the companies that we think are cheap. And again, as I said, we're focused on companies that are dividend payers for the biggest amount of our capital, but we do own companies that are non-dividend payers that we see having very good business plans, very good areas where they're operating in, and where they are beneficiaries of longer-term things like LNG Canada and the other potentials for exporting of natural gas on the west coast of Canada.
The oil and gas industry versus the Trudeau government, who do you think will win?
Right now, nobody. The industry is losing jobs. The industry is losing cash flow. The industry is losing companies that are going bankrupt. You can't get that back. The longer the price of oil stays down, the worse the industry is. And politically, for Trudeau, he needs to have a healthy energy industry. His environmental goals will not be met if he's got to spend 80 or 90 trillion or billion dollars, in terms of the security packages for keeping the economy going. His budget deficit's going to have holes blown in it like crazy because of the lack of people working and paying taxes. Everybody's a loser here. And the quicker there's a solution to the COVID-19, you can then get back to economic planning based on the data that's typically, monetary and fiscal policy dominated. And this health issue is one that we have nothing to control it from the history books. And we don't know if this is like SARS or is this like the Spanish flu, or you don't know if it's even worse than that. Right now, the positive is China and the fact that it's under control. The negative is that Italy, which has a much smaller population than China, is now experiencing very, very difficult conditions, and it's a very sad situation for them in their healthcare system and for the people who are passing away from the disease in very, very short periods of time. So it's a very very difficult situation, and we don't know what the triggers are that affects. At one point, everybody says it's one that hurts people who are elderly, people who have health issues, from smoking, and anybody over 70. Now we're seeing that the disease is now affecting younger people who are not smokers, and we're not sure what the triggers are, and that in markets and day-to-day people living hate uncertainty. They want to know what's going on. They want a little comfort. And while the president may spin it his way too positively, Dr. Fauci, who's on with him all the time, kind of spins it a lot more realistically, based on his fact-based evidence system. I think you almost want to, put the mute button on when Trump's speaking, and then turn it on when you hear Fauci and some of these other, serious medical people get on and talk about what they see going on. And I like it when you see the briefs later and during the day, even from Vice President Pence, because you're getting more realistic. I think the closing of the border with both North and South, with Canada and the United States, and now United States and Mexico, everything we can do to lower the chance for this spread is positive. New York going into a shutdown. Canada now having a shutdown, right? Everything from gyms to restaurants. We're doing what we need to do. There's some people talk maybe even that, domestic travel in the States or other planes will come down. We're seeing announcements by, the major airlines. They're cutting back traffic because nobody wants to fly even domestically. And international traffic is totally being shut down. And once the people come back home from the overseas emergency flights, whatever we can do to get a hold of this thing, that is job number one. And if we're successful there, then we can start talking about, okay, how do we get the economy back on track? How do we get people back to work? How do we get students back into the system to get their education? But right now, it's quarantine. That's priority number one to get control of the impact and hopefully the the number of people with incidents and cases goes down, and more importantly, the number of people who are not successfully surviving, that the number of the caseload there drops or doesn't go up as much as it has in Italy. That's very, very sad.
Is the climate change narrative being debunked?
I don't think it's being debunked. It's going to be ignored for a while. I think the issue of COVID and people staying alive, nobody's worrying about the long-term climate issues. What people have noted, though, on the climate is that as the quarantine issue was done in China, and people were not allowed to move, the quality of the air in many of the places around the country improved significantly. There was an interviewer on Bloomberg earlier from New York City saying that because of everybody being at home, the quality of air in New York City has improved because the coal-fired electricity plants weren't working at full capacity. So, there are little sprouts of benefit out of this. But again, as I said earlier, we need to resolve and succeed on defeating COVID. Is it going to be some of these drugs they're talking about? Is it going to be the quarantine? We don't know it, and the unknowns are what's freaking markets out and have beaten up the energy sector more than any of the other industries around the world, and definitely the energy industry has been the most severest hurt in Canada as a big industry. But in terms of individuals who are in the restaurant and service business, they themselves as individuals, are feeling the pain of what's going on, and hopefully the EI access so that they can pay their bills, and that the banks are responding as they say that mortgage payments and loan payments will be deferred. The whole system has to react on this, and we're optimistic. I'm optimistic that we will see a positive resolution. But every day you come in, you listen to the caseload in Italy, or you hear of any of these press conferences in Canada or the United States, or even in England, and it kind of throws you for a loop, saying, "Wow." So the only thing I can say is, as an individual, do what you need to do to self-quarantine in Canada. Hopefully you have enough food supplies in the house. And then when you do need, send out the healthy person to pick it up. And again, keep your distance from other people. And hopefully we come out of this okay.
What's the latest on the building of pipelines in Canada?
I think we're looking at TMX having some approvals, but it still needs some local approvals within the lower mainland area to go forward. So it's still up in the air until those are resolved. And again, COVID-19 and what's going on now trumps any movement that the feds would have to move that forward with the local areas. And the local areas are worried about, the BC number of caseloads and casualties, fatalities. So we're not going to see any progress on that for now. The other one, of course, is the First Nations, the hereditary chiefs are still trying to find and get a vote of all of their people before they can make a decision and a deal with the feds and coastal on the areas of land where the pipeline can't be built for now. Other parts are being built, and so again, we need both of those to move forward. The issue of the KXL pipeline in the States, again, that's going to be the politics of the U.S. election. If Trump wins, maybe there can be some way to move that forward. If the Democrats win, and again, it's now looking like, it's as they always would say about elections, it's the economy, stupid. And if the economy is weak in the United States because the COVID is still running rampant by the time we get into Q3, and if the U.S. stock market is still in the doghouse, down a third from the high, 30,000 to 20,000, the chance of President Trump getting elected, the odds go down significantly, and the odds for Biden getting elected and a new president comes in is very likely. So. Is this like the Great Depression when I'm not sure if it was Calvin Coolidge was the president of the United States and he lost out to FDR in the election, and by the time Coolidge came in, the economy was good, but by the end of his first term, the economy was in terrible shape, and he was defeated by FDR. So I think we're looking at something similar potentially happening if the COVID-19 is still in front of our minds in August, September, and if they go to a balloting system where you don't go to a ballot box, but they send you your vote by mail, and you mail it in, or you do it electronically, and you just put in your passport number or your driver's license or some way for verification, and then you make your ballot from home. Then the election may not turn out to be Trump's to win, but it'll be his to have lost.
Where do you see the price of oil going from here?
Well, the price of oil can't stay at the present level because we're looking at a major disaster here with the price of 20. The industry cannot function at this price. My expectation is that we are going to be seeing sometime in Q2, Q3 that we get control of the COVID virus. It runs its course, and we see economic recovery in the fourth quarter. If that's the case, I think we'll see prices get back over $60 a barrel. And at $60 a barrel, the stocks where they are today will not stay at these same prices. They will be much, much higher than they are today. The market is discounting these low prices and the fact that the industry is going to see a large. I don't believe that's the case, and I think that we will see recovery. There will be a better day. And right now, if you own stocks in the sector, bank stocks, you own other names, stay with the names that you own and be patient if they're good quality names. And when we wake up from this healthcare nightmare, we'll be looking at a better situation 6 months down the road.
Where do you see natural gas going?
Natural gas is trading, in the $1.80 to $2 an MCF. I think with the lack of capital spending, we're probably going to be looking at over $2 an MCF in the second half of the year. And I think we'll be looking at even much higher prices as we get close to the LNG exports. By the time in 2023, 2024, when the LNG pipeline gets filled and we start seeing exports on the West Coast, it's likely we could be in a $2.50 to $3 an MCF environment. And with the low cost of the industry, it would be very economic and quite profitable. And so the companies that are focused on in Northwest BC and, Northeast BC, will be big beneficiaries of the gas volumes, and they will be shipping to the LNG. And the gas that right now comes in from northeastern BC into northwest Alberta, which has been part of the glut and why we've had low prices, that will then strengthen the prices for northwestern Alberta natural gas. And then the gas that goes into eastern Canada, the gas that goes to the United States through the pipeline systems will be at much higher prices. So the whole thing of swinging around and adding 2 to 3 BCF a day in an industry that's producing, let's say, 13, 14 BCF a day, we go from a BCF of excess capacity to 2 or 3 BCF of shortage, which means the industry has to get enough cash flow coming in so that they can drill up and bring on the new production that's going to be needed. And that, of course, when you have that shortage, you're going to see prices stronger versus like right now where we have a glut of oil from two reasons. One, OPEC raising production, and two, demand falling because of the health concerns and the economic impacts of COVID-19. So that you've got 2-3 million barrels of more production coming on by Saudi Arabia, 2-4 million barrels of less demand because of the health issues and COVID-19 slowing economic growth. That's putting pressure of prices and took prices down from 65 at the beginning of the year for WTI down to the low 20s here. And again, in 2023, if we're looking at stronger demand for natural gas because of LNG and you have less production, that will be the thing that drives prices up. So it's at the margin. You have a little too much, prices get murdered. You have a little too little, prices take off. And I think that's what we're looking for is a swing where we go from the problems we're having right now to the industry stabilizing by the end of the year, to the industry seeing better commodity prices, and then at the beginning spending the money on their balance sheets to recover get their balance sheets back in order, get their creditors on side again, and then from there they can look at growing They can look at, say, if my stock is cheap, is it better to drill a new well, or is it better for my normal course issuer bid? And for those companies that like the dividend model, okay, when can I pay my dividend again? When can I increase my dividend again? Hopefully those are discussions that we have in 2021 and 2022 versus the discussions we're having right now of what do we do to survive.
How can people find out more about the Schachter Energy Report?
Yeah, we have a website which has some free research so you can see what we were saying in the past. Again, this COVID thing threw everything for a loop, but it's www.schachter, SCHACHTER, energyreport.ca, and then they can see on the website, the free material, and also they can see the two options, which are an annual subscription or a quarterly subscription, and then they can just key that in and become a subscriber. And if they do, they can go into the archives and see the old research. They can get our current research, which is changed because the models have changed because of the pricing, and also more importantly, and probably the best value right now to get up on what's going on is the webinar we did last night. I think was a 2-hour webinar, very well received, and for people who want to get up to date on what's going on in the markets, know about the previous bear markets and market crashes in the past and how they went, how long they lasted, how painful they were. Compare that to the one that we're having now. I think it's a very good education piece, even if you don't buy energy stocks. The macro portion that we put in there is helpful for whatever area of the markets you're investing in. It will be of significant help to you, and our macro work going forward would be something for people to keep an eye on.
Joseph, thank you so much for being on This Week in Money.
My pleasure again. Thank you very much.
My guest has been Josef Schachter, founder of the Schachter Energy Report, online at schachterenergyreport.ca. He was speaking to us from my birthplace, Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Josef Schachter, and thank you for listening. If you have any questions for our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President and CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's great to be on the show.
Larry, the coronavirus affecting operations of so many different businesses, how's it hitting yours?
Well, it hits it everywhere. We're currently down to about half the people in here, but one wasn't due to a coronavirus. Terry, the one that looks after all of our communication with the exchange and all of our corporate aspects. As a matter of fact, she is the corporate secretary, was hit by a car, unfortunately, and got a concussion. She's out of here for a couple of weeks, and Zarko's isolated, so that doesn't leave many in the office, so but we're carrying on with everything that we can do. And currently, of course, with Cometco, they're down to a skeleton crew because their operation has about over 30 employees, and so they have to shut down, and they've got a skeleton crew working in there. So it just affects the timeline a little bit, but overall, everything that we've done has been great. Everything that Cometco's done has been had fantastic results, so we're very happy with that. But the coronavirus is also stopping us on a corporate level. We were into some exciting work with a group, and actually a political group, and that has been slowed down. So we're just
maintaining and keep things going. We still getting a lot of press out there. I've attached quite a few articles to this podcast that talks about things that are happening around the world and different areas we were mentioned, like in some radio stations and everything, in TV stations, I should say, in the U.S. But it doesn't seem to help much. It seems like you get, like, just in the last hour, you had a group that basically knocked the price down from 12 down to 12.5, down to 10.5. But that again is temporary. That's not going to stay there. And but it does tell you that the predator trading is going on. I'm really disappointed in the Save Canadian Mining Group. They have lobbied nobody about bringing back the uptick rule. And I think that's what we all put our money into, see something like that happen. But unless they have an interview or something like that to post, I don't see anything where they're lobbying the exchanges or the government or anything to reinstate. There's pressure put on Trump in the U.S. and the SEC to reinstate the uptick rule, but you just don't see that happening up here. People just, I don't know. I can't get their mind wrapped around it, I guess, but they're not realizing that their value is being destroyed by predator trading. And that's unfortunate, because if everybody got behind it and started lobbying their MPs and lobbying the exchange and IROC and the regulatory bodies about bringing back the uptick rule, which strangely enough seemed to work for 82 years, and now they claim they can't bring it back because of all the platforms out there. I'm really not seeing that. But I can't understand how you just can't change the rule and all the platforms have to oblige. You know what I mean, Jim? But anyway, that's my usual complaint. But the fact of the matter is the stock market has looked like it might be stabilizing. And, if we see a few more days we're flat or maybe ticking up, we might see some stabilization. And that'll come not from predator trading or anything else. It'll come from the coronavirus when everybody starts getting back to work. China's almost all back to work now. They had after their quarantines and everything, they had a period of flattening out, and now the reported cases are dropping. Same thing with South Korea. So, these things are happening, and it looks like it may be happening in the U.S. So, once that scare is over, and it seems to have been beaten into a frenzy, and I'm not saying that the coronavirus is not something to be fearful of. It's the fact that it seems to be coming under control, and that's what we look for. We don't like to see people, dying from the coronavirus, whether they're older or whether they're younger. It doesn't matter. Any life that's lost is life lost. There's nothing you can do to get that back, but you can certainly curtail the advancement of it. And so that's what the governments around the world are trying to do. There's been lots of things that have been enacted because they've shut down small businesses, which is going to affect them in a very negative way. And but they're also supplying money to the people that were working there, and standstills on rent and different things like that that just have to be beneficial for the whole market. And because it's this is going to be a trying time crawling out of this hole, and but I think the market, as fast as it went down, it can go back up just as fast, and I see that on the horizon. And even if it went back up only 50% of its losses, that's a good area to start from. And, things are happening in the recycling world, which I've attached some articles that now the focus seems to be on it. And so that means that companies like AMY will benefit from that. And you'll probably see that where we might fit in the puzzle down the road. But the total thing is that I see an end to the coronavirus. It's from everything I'm reading. And I think the markets will be coming back, and a month from now will be as business as usual. And there's a lot of people, of course, that are looking at this area to buy the stock. It's down 50% from where it was. And this would be a good entry point. I can't say whether it is a good entry point because the markets, I don't control the markets. And trying to control your own market is a full-time job. So, you keep the information flowing, let people know that, the patents are granted, and show me another company that has patents out there, and I'd be very happy to do a due diligence on that. But I don't see them. And, this is going to be the most important thing out there. This is going to be the final step in the development of the EV cars and the manufacture of batteries, and now the recycling of batteries is going to be the next big move. So, one of the articles is talking about a $150 billion budget on the recycling and reuse, and that's a lot of money thrown at a very serious problem, and we can't help but benefit from that.
Larry, for people new to American Manganese, what is the company all about?
Well, American Manganese is a critical metal company that developed a excellent process for processing very low grades of ore in the U.S. for the manganese business, and that's a critical metal, one of the top ones. And we've taken that as a cornerstone for developing a solution for recycling lithium-ion batteries. We've shown that we can do up close to 100% of the recapture or the recovery of the cathode materials like lithium, nickel, manganese, cobalt. And, this is going to be a big step in the future for the company. So information can be found at our website, AmericanManganeseInc.com. We're traded on the Venture Exchange, the Toronto Venture Exchange, under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. And we're traded in Frankfurt under the symbol 2AM. You can reach me at LREAUGH@AMYMN.com. Or you can phone here at the office at 778-574-4444. And just before I sign off, Jim, I'd just like to say that our third OPAD out there that we have with the Economic Standard has had, as of almost 10 days ago now, we had 40,000 reviews, so that's been well placed. That takes us up to about 156,000 views in 3 letters, and I'm sure that helps spread the word on the company. So I wish everybody a good weekend.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on March 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.